Hi, everyone. I'm really pleased to be joined by Paul Cooksley today, who's going to talk to us about mortgages for the self-employed and company directors. I'm really excited to talk to Paul about this particular subject area. We refer quite a lot of people onto Paul, and he's been absolutely brilliant at helping our clients get those all-important mortgages over the line. I think a subject that's quite difficult and sort of people struggle with and they worry about it, making that jump to self-employment. So thanks very much, Paul, for joining us and welcome.
No problem. Thanks, Justin.
So Paul, just to kick us off, just getting a mortgage, and you're a broker, aren't you? So why should we work with you as a broker rather than trying to find our own mortgage?
That's a good question. I mean, starting off with money, first of all, obviously you don't go down to the pub and things like that and really talk to your mates about these type of things. And a lot of people keep their own personal business private, which I do completely understand. But like most other walks of life, you do go to other people to get advice. Obviously, like an accountant, it might be somebody, a kitchen fitter or something like that. There's a lot of things that you can do yourself, but it is often better to go and speak to a professional. Now, going to a broker like myself, the first starting point is we have access to a lot more lenders than you would do yourself. And we know different bits of criteria that might place you better with one lender than another. A lot of people will say, oh, just go to my bank. But unfortunately, the banks don't really look at you as an individual. You still have to meet the criteria and the rules, and you might not for some reason. And there's a lot of time it can take you to do that. Whereas coming to a broker, like I said, like myself, takes a lot of that away, and we will place you with the best people that's right for your situation. And ultimately, that should be a better financial situation for you as well.
Okay, fantastic. I know we've seen that over the years as well, where we maybe look to consolidate debt for a client, and you've immediately said, oh, yes, this particular lender will look at it from this criteria, and I know that that's super helpful for clients. So let's say we need a new mortgage. We're self-employed, a company director. I know you have a prescribed procedure in which you follow, and there's various steps that that person has to go through. So how does that start? What do you ask for initially?
Yes, well, getting a mortgage is basically a tick box exercise. So you would start at the left, as it were, and you work your way along until you physically get the money. So the first thing that I always do is check that a person is okay to get a mortgage. And we would start with that by getting your credit report. Now, there's quite a few out there. The one I particularly prefer is called Check My File. You would get a 30-day free trial with that. But that links to the big agency and gives me the background information about yourself and whether you're able to get a mortgage. It makes sure that you've paid your credit commitments on time already. It lets me know about your credit commitments, things like where you're registered on the electoral roll, and a lot of things that will help for me to know which lenders may or may not lend to you. The other side of it is income proof. Now, again, with all lenders, they want to make sure that you're okay to repay this mortgage. So I would need to see kind of how you pay yourself and what you pay yourself. And then depending on what you're doing, if it was a purchase, you'd probably have a deposit. And obviously, if it's a remortgage, it would be the information of the property. So it's three main things, which would be your credit report, your credit situation, not just your credit score. I think that's key. I don't know if you're going to come on to that, but that's key. Your credit report, your income proof, and then I say whether it's a purchase or a remortgage.
So what is the difference, Paul, between a credit score and a credit report then?
Very good question. So you probably see it on the TV a lot that people go on about their credit score, and your credit score is a kind of hypothetical number that a credit agency will give you. Obviously, the higher the number, generally speaking, the better that you are. But actually, the most important thing is your account conduct. So we look at your overall credit profile, which is your full credit report. So that will list all your credit commitments, loans, credit cards, car agreements, and how you're servicing that account and making sure you're paying things on time, what your balances are. Are you using the full limit of your credit card, for example? It also tells us about where you live, where you're on the electoral roll, how many searches there have been recently. If you're applying for car insurance, home insurance, there could be a lot of searches. And all of these things make up your score. But the score isn't the most important thing. It's the account conduct to make sure things are being paid on time, basically. Because you can actually have a high score and a low account conduct. And you could actually have quite a low score because you might not have any credit, for example. So it's like I say, it's about the full report and looking at the bigger profile, not just what the number says.
Okay, that's very interesting. And I presume if someone buys their credit report from somewhere like Check My File, which is something I've used in the past, especially when you've helped me with my own mortgages, we can improve that, can't we? We can start thinking about our mortgage really sort of maybe a year in advance and hopefully make some changes, improve that account conduct? Have you seen clients do that?
Yeah, definitely. One thing that I always say to people is chat early. If you're looking to move next year, have a chat now and get everything in order so you know what you can look for when you're maybe looking for a property or the remortgage is up. So yeah, maybe you get your credit report and there is a slight issue on there. There could be some fraud or something that you weren't aware of. So it's always good to get that sorted first. I've got many clients where things have been put on their account accidentally by the provider. And again, they go and speak to them and get them removed. But one thing I mentioned there was about lack of credit. Most lenders, when they search for you, it's basically a computer check and you're trying to get some hypothetical points. If there's no information on you because you've never had a loan or a credit card, it's very hard for a lender to then score you, as it were. So even things like going to get a credit card, putting a tank of fuel on it a month, and then clearing it off, that's really important. Make sure at least the minimum payment is paid, or clearing it off every month will show that you're responsible with money. And that's how you can improve your score. It's not a case of going to get 10 loans and 10 credit cards and never pay them. Just get one and use it every now and then. But like I said, make sure that at least the minimum payment is set up, or clear it. And that's the same for all loans or credit cards. You should always have the minimum one set up. With mortgages, it's absolutely fine to have credit. You've just got to service it. That's going back to the credit report and making sure you pay everything on time and you're not getting these missed payments.
Okay, and let's talk about before we move off credit reports. What happens? We've missed some payments. A client's missed some payments. Is that the end? Are they not going to get a mortgage?
No, there's two things that come down to it. It's the severity and time. So all lenders have different criteria. We kind of have sort of three-ish tiers that we would say. We have the high street, so all the big names that you've heard of. Their criteria might be a little bit more strict. So they're looking for less missed payments or things a bit more historical. You've then got the more non-high street, which are probably banks and lenders you've heard of, but they're a little bit more relaxed in the area. And then you sort of have the third one, which we call adverse lenders, that are there for people that might have unfortunately had a few problems in the past, or multiple missed payments or even defaults or county court judgments or something like that. And it basically comes down to, like I say, the two things: when they were and how many. And a lot of lenders will have tiers. So if there's not many and it's quite a long time ago, you might get the tier 1. If it's a few and quite recent, you might get tier 5. And all that is the deal's a little bit more expensive. So no, it's not the end of the world. It's just, again, that's why I use a broker, because I know where to place you with that and who would consider your situation.
Back to that criteria thing, that's all important that you
Yeah.
need to look. Yeah.
Again, it's a tick box. That's what he said. It's a tick box. We're trying to put you with the right people. And based on your information, when we've got that, I can place you with the right people that are more than likely going to accept you, rather than kind of doing pot shots on people when you don't know, is the short answer.
Okay. So, I mean, one of the things we were just touching on there was about account conduct. And I know that quite often the lender will look at bank statements for someone. I'm always giving a piece of advice to our self-employed and company, particularly company director clients, that lenders like to see them getting paid at the end of the month like a normal employee, although they're likely to be earning the director's minimum, and then to draw a dividend on a monthly basis, normally once a month, and again pay that at the end of the month. And I always say, oh, that would be really good for mortgage, getting a mortgage in the future, because it shows account conduct. Am I right in saying that? Is that right?
Yeah, it's certainly helpful to do that. Again, looking at it from the lender's point of view, they're ticking boxes. They want to make things as easy as possible. So if you can present yourself in the best way, you're more likely to get your mortgage. And yeah, definitely, if they can see your salary going in every month and it's consistent as if you were employed, then that just helps your case. If it's sporadic, they don't know what it is, it changes, it's a lot harder for them to understand as well. So you kind of sometimes have to take a step back and think, right, what might the lender want from me? And then doing everything you can to do that and just make it as simple as possible. So yes, if it's clearly stated once a month, there's your salary, there's your dividends. Again, it doesn't mean that you can't, but you're just trying to tick those boxes and make it easier for everybody. So certainly, yeah, you can do that.
And going on to company directors, although we, on the whole, most company directors get paid a kind of a small amount on payroll. Do lenders, sometimes directors say to me, do I have to do that? I mean, that's good for mortgage advice, isn't it, to be able to produce a payslip? Am I correct in saying that?
Like I say, mostly all lenders have different criteria, and it's always helpful to have these things to hand, because they will start asking more and more questions. And some of these more adverse lenders that we mentioned, for example, they ask for a lot more documents. So the more things that you can have available to you, the more chance you have of getting a mortgage. When you're self-employed, you generally sort of do things once a year, maybe every April, where it's your personal tax return. But they want to see what's happening throughout the year. So yes, pay slips can be helpful as much as accounts can be helpful as well.
Okay. Another question that's sort of coming to mind is someone is just about to move from employment into maybe their own company or self-employment. Are there any, will that affect their position to get a mortgage?
Generally speaking, yes. Now, I can only kind of, like I say, speak about general situations here. There's always little things you might be able to do or twist things a little bit. But generally speaking, when it comes to self-employed, lenders will want you to at least be trading for a year and have 1 year of accounts. One thing I sometimes hear is that self-employed people are penalised. They're not. It's just slightly different rules, because you could go and get a job tomorrow and you have a pay slip. Whereas if you go self-employed, you have to wait that full year. So you have to have, generally speaking, a minimum of 1 year trading and 1 year of accounts. Most lenders, it's 2 years. So that's the only way you're penalised a little bit. It can take a bit more time, because lenders are just looking for history of income. You know, without that year, if you asked anybody going self-employed, how much do you earn? They won't know, because you haven't completed the year.
Okay, so it's probably a good advice if someone is planning a business, 6 months down in advance, and their mortgage deal is coming up. It's probably a good idea to get that reviewed before they make the switch into self-employment or their own company.
Oh, definitely. Again, it comes back to speaking early. Like a lot of people, like I say, don't want to, or they feel scared. But it's always better to know, if you're looking to move at the end of this year, for example, what you need in place. And that's a prime example of, you don't want to be moving in December and in November you've gone self-employed.
Okay.
You just want to plan ahead and think about things a little bit.
Okay. Let's sort of move the subject onto tax and profits and all of that sort of stuff. So I'm guessing a lender's going to want to have a look at your tax return and to see how much you're earning. I mean, how does that work? What period of time do they look at? Is paying your tax on time important? Those sorts of things?
Yeah, so this is one area that's been picked up a lot recently. Historically, self-employed people were, the criteria is a lot more relaxed, and unfortunately, things have gone a little bit south in the financial market, so they are a little bit more stricter. But again, it's all proof. It's just backing things up. Like you would have your payslip every month, they want to see your personal tax returns. They want to see the company accounts, because ultimately they want to make sure you can pay the mortgage. And obviously, if you're paying yourself something, there's normally tax to pay. So they ask for another document just to make sure that tax is paid. It's called a tax year overview. And it should basically match your personal tax returns that says you've earned this much, therefore you should pay that in tax. Can you prove it? That's it. They're not there to catch you out. They just want to make sure that you're paying these things. So again, tick boxes, just doing everything correctly is what you should be doing.
Okay. And is it important to show an upward trend of earnings, or does it matter if your profits fluctuate from year to year?
If it fluctuates, that's fine. Lenders will generally take an average of your income over the last couple of years. So yes, if it's fluctuating up, down. If it's in continual decline, it can look like, unfortunately, the company is struggling. And again, a lender will be concerned by that, because they don't want that trend to continue. So again, going back to the point of, they want to make sure you can afford the mortgage. They don't want to be repossessing properties. So if they've got any issues or concerns, they're there protecting you as much as they're protecting themselves. So yeah, fluctuating fine. Ideally, if it's going up, it just means you can borrow more money. But if you can avoid the kind of continual decreasing in profits, there might be some reasons for it. Obviously, COVID was quite a big one. Somebody could have been on maternity or something like that. But generally speaking, yeah, try and get the profits in an upward trend, or certainly very similar.
Okay. So, I mean, how much can somebody borrow? I mean, if they're self-employed, it's a very general question, and I know there's lots of different criteria in here, but is there a rule of thumb clients can follow?
Well, again, all lenders are different with their rules, but generally speaking, most people are between 4 and 5 times income. Now, that's not including credit commitments or children that you might have, or things like that. But if you wanted a very, very rough guide, certainly if you're self-employed, take your last 2 years' income and times it by 4.5. It will certainly put you in a good ballpark area. Now, obviously, it does depend, like I say, on many other factors as well, which is why, going back to the credit report, those things are handy to look at your affordability. But yeah, as a real ballpark guide, so somebody on 25,000, they're going to be somewhere just over 100,000 that you could borrow.
Okay, that's really great advice. You touched on some things there that I just wouldn't mind exploring a little bit further. I mean, one liability that you mentioned was children, and then just generally about other liabilities, the amount of debt that we've got. I mean, how does the level of debt and children factor into a kind of a mortgage application?
Again, they look at the affordability of things. If we go to the residential side of it, for example, if you say that you had £1,000 a month paid into your bank account, they know on average when they look at statistics how much you will pay on food, gas, electricity, council tax, and like I say, if you have children, maybe there's nursery fees, maybe there's private school fees or anything like that. So lenders will have an approximate figure of what you pay. You'll be then left with a net outcome at the end of the month. So let's just say you had that £1,000. They say that you have £600 of outgoings. If you've also got a £200 of loans, that only leaves you with £200 a month left from your income. Is that going to be enough to pay the mortgage borrowing? Probably not. So that's how they look at it roughly in the background there. Because like I said, they've got to make sure you pay the mortgage based on all the things, which is why they look at your overall profile for loans, credit cards, children, any other major outgoings that you might have, and then look at what the monthly mortgage payments would be, and are you going to have enough money overall to cover that?
Okay, that's interesting. All of this sounds like a huge amount of hassle. Pay slips, bank statements, credit checking yourself, all of these kind of things. I mean, is it not just better to go on the standard variable rate if you've got a remortgage and just leave it on that? I mean, do we need to do this, Paul? I know that's a loaded question.
Well, again, if you put it to everyday life, you have your gas, electricity, where you shop around, your home insurance, your car insurance, where you'll continue to shop around. You should do the same with your mortgage, basically, because it's the biggest outgoing you're going to have. Yes, people do see it as hassle, they see it as a problem, but it's not if you get the right advice and you get everything in order. The people that struggle are the ones that don't have the documentation or don't want to think about it or might just not be bothered, is the short answer. But the process isn't that difficult. And if you've already got a mortgage, most lenders will give you a new deal without reassessing you, which actually means you don't need to produce a load of documents. So there shouldn't be a need for you to go on the standard variable rate unless you might be moving next month, for example. But generally speaking, you can go back to your existing lender and see what new deal they would offer you. I've had it where people have actually lost their jobs or become unemployed and they're still able to get a new deal. So yeah, you should always avoid the SVR unless there's a specific reason why you're going on it, as much as you wouldn't let your gas electricity go over to standard variable. Generally speaking, obviously today's time is a bit different. You would always be looking for a new deal and something better for you.
Obviously, when the time we're recording this, I mean, the base rate's been on the up, hasn't it? So the standard variable rates tend to be very, very high. And I know from looking at some of the deals that you've been offering to our clients and the kind of the standard variable rates, there is a huge, huge, huge difference. Just to kind of change the subject, we've got lots of clients as well who are interested in property investing as well. Is it the same system and the same rules if we were looking to buy-to-let properties?
It's a little bit different. So on the residential, it is all about your affordability. So basically your income and outgoing versus the mortgage. With a buy-to-let or investment property, it's more tick boxes that they look for. And again, this isn't set in stone, but generally speaking, they would prefer you to be a homeowner because there's a kind of question of why would you buy your first property as a buy-to-let instead of one for you to live in. So again, there's some rules around that, but that's not saying all lenders require it. Most of them have a minimum income requirement of £25,000 because what they're making sure is if you didn't have a tenant, hopefully you would still have some money left over to pay the mortgage. And then it's a rental calculation that says for you to get a mortgage of X, you would need rent on that property of Y. Like I said, these rules are all slightly different, but that's a general rule of a homeowner, £25,000 income, and then a good rental income on the property.
Okay, that's interesting. And we've also got clients who are wanting to buy properties within a limited company for tax reasons. They don't want to have to pay the tax personally and shelter it into a limited company. It's possible to get a mortgage within the limited company?
Definitely, yeah, becoming more and more popular. Again, there are less lenders that do it, which is another reason for myself going to a broker, because a lot of the high street banks don't actually offer limited company deals. They are slightly specialist at the moment. Lenders will assess you as the director or directors who are ever on it. So you still have to meet those general rules. So for example, if you hadn't previously paid a mortgage or your credit commitments, you're not going to get a mortgage just because you're doing it in a limited company. So the standard rules do still apply.
Clients often say to me, oh, it's going to be a lot more expensive for finance in a limited company. Is that true?
At the moment, deals are a little bit more expensive. Yes, I think as soon as you mention anything kind of business or commercial, fees generally go up. It's nothing extortionate, but yeah, limited company deals are a little bit more expensive than mainstream ones at the moment.
Okay, great. I think I've covered off a huge number of general points, and I think we've got a really nice kind of overview, I think. Is there anything that you wanted to add before we wrap up?
I think it's more just a summary. I like to say, chat early, speak to somebody like myself, and get the information so you know what you need to do moving forward. Try and present yourself in the best position that you can, because, like I say, a lender wants to be able to just tick off all your boxes as well. They're not doing these things to frustrate you, annoy you. They want to make sure it's all right. Ultimately, they're the ones lending the money, and they can make up whatever rules you like. But you've just got to be able to meet it. So if you chat early, and I can explain to you what you need to do, you can do a lot of planning. You can Your clients will speak to you as well, Justin, when you're providing their accounts, and you can actually get the figures to what you want them to be. It's not a case of a lender saying, this is all we do, take it or leave it. You can actually get yourself in a position to present yourself well to a lender and get everything that you want with a bit of planning and a bit of forethought, is what I would say.
Great. And how do people come and work with you? I'm guessing that you want people to come and work with you.
Yeah, definitely. I mean, one thing I do is work on referrals. Like I say to Justin, when people come in, you're very kind of referring them over. I've got my own website as well, so Solidus Financial Services. So you can drop me a line on that way as well. But yeah, just get in contact however you can. I'm on LinkedIn as well, so Paul Cooksley on LinkedIn. Like I say, the company's Solidus Financial Services. But I'm happy to just have a chat. If you just want to know what the process is, you have no idea how it all works, please just get in contact, and I will more than happily have a chat to you and hopefully point you in the right direction.
That's brilliant. I'll obviously below this video share Paul's contact details, and I'll put his email in there. So if you want to just get in touch with Paul, you can do, of course. A big thanks to Paul today for sharing all that wonderful information. I've tried to keep it short and snappy today because I know as self-employed and company director types are very, very time poor. So I just want to kind of make sure we've hit off all of the key highlights. So thanks again, Paul. I really appreciate it.
Thank you very much.